Hey traders, this is Blake Morrow with Trader Summit, and for the very first time, I have Mr. Jay Kaeppel. He is senior market analyst at Sentiment Trader. Jay, it's really a pleasure to have you here.
Thank you very much for having me here, Blake. I appreciate it.
Yeah, I really appreciate what you guys do at Sentiment Trader. I think you do some great work. You analyze the markets, but more importantly, you shed a lot of light on a lot of different aspects of the market. Tell us a little bit what you do there.
Well, the thing that I like about working at Sentiment Trader is we're not prognosticators. We don't manage money. We don't make forecasts. We're not investment advisors. We're researchers. So we're free to just objectively analyze data and see what we see and just report it that way. So we don't try to make it out as, hey, you should buy this because that. It's here's what's happened, something that just happened. Here's when that's happened in the past, and here's how the market has reacted, and then people can make their own judgments, accordingly.
Well, in today's market, where we're currently sitting, we're around the S&P is around 4,000. Market's trying to figure out, is the Fed going
Yeah,
to pivot?
yeah,
Are we going to see some sort of reversal because the Fed's going to just continue to raise rates? Whether it's inflation data, whether it's jobs data, but we're all looking for that edge. And
right.
you say you've got some information that might get us there.
Sure. Yeah. Let me share some things with you that
Yeah.
we're looking at. And there's a lot of confusion in the markets these days. Depending on what factors you focus on, you can be extremely bullish or you can be extremely bearish, and you can make a very good case. And you'll see that as we go. So I'm going to share my screen and we'll just go through some of these things. So
Perfect.
at the top, a lot of the big picture items are mostly all still unfavorable as we rank them. So, if you're looking at inflation and you're focused on, as you said, the Fed and interest rates and even the economy, it's very easy to be extremely bearish. However, if we look at some of the things that tend to tell us when a turn may be coming in the market, or in some cases has already happened, those are turning decidedly bullish. So it's really important, I think, that even if you're super bearish right now, to open your mind to the possibility of a change in the market. So let's focus on some of these. I'll trim it down a little bit. But so the big picture factors: price action, inflation, and the economy. Now, the good news in price action, well, the bad news in price action is that technically it's still negative as I rate it. And here you see four major indexes, all with their 200-day moving average. And as you know, there's nothing magic about moving averages, but it's just a way to quantify whether you're at the moment in an uptrend or a downtrend. And at the moment, most of these are either in a downtrend or right on the edge. So it's really an important time to be keeping a close eye on these. I also follow these other four, which are semiconductors, transport, utilities, and the value line index, more of a unweighted index. And all of these have kind of crept above their moving averages. So this is probably this particular indicator is probably a few days away from actually giving a buy signal if the NASDAQ and or the S&P can kind of get some oomph and get over those lines. So it's really an important time to be keeping an eye, because sometimes these things whipsaw. But when price trend starts going up, especially when you don't think it should be, that's a really important time to be paying attention.
And Jay, as a trend follower,
Yeah.
most of us, lower highs, lower lows. It's a pretty,
Yep.
it's
Right.
obvious. But in all of those sectors that you're looking at there,
Yep.
we stop making lower lows as of right now, and we are
Correct.
at risk of making higher highs.
Yeah, it's just trend following. The thing about it is it's nothing magic, and there will be whipsaws, and you have to be prepared to deal with those.
Sure.
And get out when the time comes, and then get back in if you have to. And that's very hard for a lot of people to do. But the trend is your friend, as they always say. So the next thing, of course, that's weighing on everybody for the last year is inflation, and a lot of confusion. So this chart is the 12-month change in the consumer price index since 1914. And you see where we are. Obviously we're in a higher range. But people are confused. They're like, well, should I be happy that it's now trending lower, or should I be unhappy because it's still over 6%? So a study that we did a while back, what we found is when that 12-month change is between plus 4% and minus 3%, that's moderate inflation, let's call it. That's a good time to be in the market. And when it gets outside of that range, it tends to be bad. Too much inflation, or certainly too much deflation, is bad. And let me just draw the picture to show you what I'm talking about. This is the cumulative gain for the Dow Industrials since 1914, when inflation is in that moderate range between plus 4 and minus 3. And it's not even so much the green number that matters as it is, what you see from lower left to upper right. There can be bear markets, but the trend is fairly obvious. The market likes moderate inflation, and we don't have that right now. And so here's the history of being long the Dow when inflation is outside of that moderate range. And obviously, if you look at the far left, you see the depression, the great deflation of the 30s, but there was also inflation and a lot of choppiness in the market in the 1940s. And again, if you look at the 1970s and early 80s, the same thing. The big sell-off in 2008, most people don't realize it, but there was a bout of inflation during that time. And then, of course, in the last year, you see the market down, down, down. So it's real simple. In my book, we're looking for that 12-month rate of change to get back below 4%. And if and when that happens, I can't predict when, but when that happens, it will be a huge weight, I think, lifted off the market's shoulders. So, and then the last macro thing is, of course, the economy. A lot of concerns about inflation with negative yield curve and so on and so forth. This is one of our own indicators, Sentiment Trader Macro Index Model. And you see the S&P 500 is the black line on the bottom, and then the model itself is on the bottom. And here are all the things that go into it. I'm not going to go through any of these, but basically just various economic indicators. And once again, we did a study, and it turns out it's pretty simple. When it's above 0.7, that's good. And when it's below 0.7, that's bad, both for stocks and the economy. And once again, let me just draw the picture. So this chart goes back to 1968. This is the growth of $1 invested in the S&P 500 when our macro index model is above 0.7. And once again, that's kind of equity curve that most investors look for, lower left to upper right. And then during those times when it's dropped below 0.7, every major bear market in the last 50, 60 years has occurred when that index model is in bearish mode, down 28%. So where are we now? Well, the bad news is we are way down at 0.24. And what this really tells you, if you kind of flip it on its head, is there's essentially, it's saying there's roughly a 76% probability of a recession in the next 12 months. That's kind of the way to read it. So obviously this one is also still negative, and what we're looking for is for this to get back above 0.7. So at this point, if you're a big picture investor, you're looking at these models and you're going, wow, this looks bad. I better stay out of the market. So let's take a look at some of the other indicators, because we've been seeing a lot of signals flash in the last 6 to 7 months that kind of get hidden under that choppy market. But we'll just take them as they come here. The sentiment, we have our own Sentiment Trader Panic Euphoria model that simply measures the mood of investors based on a variety of indicators. And here we have the S&P 500, the black line on the chart, and it's real simple again. Higher readings means people are bullish overall, and lower readings means they're more bearish. And, Blake, as you know, human nature never changes, right? When the market starts to decline, people don't go, wow, it's almost time to buy. I better get excited. They get more gloomy and doomy as it goes. And this is one objective way to measure how much gloom there is in the market. And as you can see at the far right, we just had what we consider to be a bullish reading a couple of weeks ago. It reached down to that super low level. And just to give you an idea of what that might mean, so these red dots are those times in the past when that same signal has occurred. And this is the kind of analysis that we do. And this is a table. At the top is kind of a summary. So if you look at the far right on the top, is this signal a sure thing? Not at all. But 91% of the time in the past, the market has gone up over the next 12 months with an average gain of 25%. And if you look at the numbers down the right-hand side, if we get these kind of numbers in the next 12 months, I think, most of us will be pretty happy. So this is one, when I talk about when things are bearish, it's the most important time really to start opening your mind to things that you don't want to see. You don't want to see bullish readings when you're nervous and scared, but here we are. So here's one thing that's telling us that maybe it's time to start getting more favorable towards the market. Now, if you look at market breadth, this indicator of ours measures the percentage of industries that are in a correction. And we define that, the green line here is the percentage of industries that are 10% or more off of a 52-week high. So when it gets up to 100%, that means every industry group is in a correction. And once again, when we analyze this objectively, when every industry is in a correction, it's time to start looking for a bottom. And what you see here is not what I would call precision market timing, but you see clusters of those red dots. And when you start seeing that, that's the time to start looking for a buying opportunity. And again, let's zoom in on the last 2 years. So over on the left, you see during the COVID sell-off, it was actually not till after the bottom, but shortly thereafter, we got a cluster of signals that said the worst may be over, and it turned out to be the case. Now, more interesting how some of these things work. As I said, there's no such thing as a sure thing. In June of last year, it gave one signal, and then the market kind of chopped and kept chopping. And then we got another round of signals in September when the market made another low. So this to me is a bullish indication that says we should be looking for a buying opportunity if we're not already in the market. And, as I said, it's not necessarily an automatic buy signal. If you look at the red box there, you see, 62%, 67%, that's okay. But if we go out a year, each time that indicator has given a signal in the past, it's been followed by much higher prices. And again, I want to emphasize that does not guarantee that the next 12 months will show a gain of 25%, but it's just, like I said, telling me to adjust my attitude more bullishly. Now, the next one is kind of a favorite of mine, more so than probably most people's seasonality, probably because I wrote a book on it a number of years ago. But seasonal trends in the stock market, the tendency for the market, to move in a certain direction during certain times. And one of my favorites is the best 10 months of the election cycle. And as it turns out, that extends from October 1st of the midterm year through July 31st of the pre-election year, which means that we are in that period right now, right? It started October 1st and extends through July of this year. Now, I'm going to show you the equity curve. If you bought and held the S&P 500 only during these 10 months, every 4 years since 1932, this is the equity curve. You may notice a trend here, right? I mean, that's about as good as it gets. And if you look at the far right and the up, you can see we're off to a pretty good start this time around. Doesn't guarantee it will follow through and be much higher by the end of July, but that's kind of the way I'm reading it. There have been 20 consecutive up periods since 1938. And then if we just kind of zoom in, this is last year. You see down, down, down. And all of a sudden, September 30th, it became this new favorable seasonal period. And it's almost like somebody flipped a switch. All of a sudden, the market is now a lot of industry groups, a lot of stocks trying to work their way higher. So this is one more optimistic sign that things may improve. And then the last one of that group, I can do this one pretty quickly, but corporate insiders, they haven't gone crazy buying, but there's been enough. So again, one of the things that's really important for us is to be as objective as possible. So this is our, we get a database from Bloomberg, and it fortunately it only goes back about 15 years, but what we see here is the buy-sell ratio. And what you can see, obviously, is with the red dots and the red circles is when insiders start to accumulate shares and or stop selling. You know, that tends to happen. They don't necessarily pick the bottom, but they tend to be right because they know what's going on in their companies better than anybody else. So we did have a bout of buying at the far right that you can see last year. And once again, like I said, it's not a precision timing tool, but they tend to be right over a 1 to 3 year period. So since we saw some buying last year, and actually, I don't have the chart, but insider selling just fell off the chart. I mean, they just stopped selling shares of their company. I don't know why, but I'm assuming they know something that I don't. You know, and here's another one that just shows a high potential. I don't even want to say probability, but a very high potential for some good moves in the year ahead.
So I
yeah,
was going to say, Jay, one of the things that I like about what you're presenting to us at this moment is probabilities. You know, as traders, we are
right.
probabilities people.
Yeah,
So, you know, there are always going to be, you know, reasons not to buy something or reasons
sure.
to be long. But when you can stack those probabilities in your favor, you're giving us more of a, at this point in time, a more reason to be more optimistic. And I think that's
Right.
that's great to see. All right, continue on.
Yeah. So one of the things I tell people is, you know, I look for 80%, 80% or more, something like that. That gives me a lot of confidence. But the one thing to remember is you have to separate analysis from actual trading. So if you have something that's got a history of 80% winners, and even if that carries forward into the future, that means 1 out of 5 trades you're going to lose. So it's still on the investor to be very careful about making sure they allocate the right amount of capital and that they limit their risk, whether it's a stop loss or whatever, you know, a moving average, something. But you have to separate, you know, once you get done with the analysis and you stack the odds and you say, this looks like a good time to get in, the next question is, okay, what do I do if I'm wrong? What happens if I'm wrong?
Of course.
And so, yeah, so that's a real important part. And then let me sum up some of this. So 5 things that investors can look for right now, and I've already discussed some of them. Price action. We are on the edge. If the S&P and or the NASDAQ 100 move up in the next week or so, we'll have enough of these above their 200-day moving averages to rate it as bullish. Again, market can turn right around. That's the nature of trend following, but it would be the first time in over a year that we've actually had what we can quantify as an uptrend in price. So real important to keep an eye on those indexes with the moving averages. The other one that I mentioned, inflation. Now, this only comes out once a month, so this may take a while, but when inflation gets back below 4%, that's going to be a real green light, in my opinion, for the stock market. And then also, as I mentioned, our macro index model. One of the concerns I have, so you've probably seen these where like 90% of analysts or economists are calling for a recession this year, which is a little worrisome because usually when the crowd thinks something's going to happen, my thinking is either we're going to get a very mild recession or ultimately maybe later in the year, we're going to get something far worse. So my own opinion, I'm hoping for a pretty decent rally between now and let's say the end of July. And then the second half of the year, we'll see where the economy stands. So that's just something to keep in mind. Now, I wrote an article back in October. This is a public article, so somebody could Google this and find it. But I'll show you a couple of things that are in here that have not hit yet. The 100-day average of the NASDAQ high-low ratio. So every day you take the highs divided by the lows on the NASDAQ, and then we just keep a 100-day moving average. And once again, we do the same thing. The green line at the bottom there is the 100-day moving average. Now, what we look for is for this to drop to a very low level and then actually turn around and cross back above 0.29. In other words, the idea here is not to try to pick the bottom. The idea is to say, okay, the bottom is in. In other words, this is more of a confirmation, a bullish confirmation. And so this is one of the ones I'm looking for to hit before I get heavily back in myself. So you see where we are right now. It's at about 0.25, the 100-day moving average. So it's got to get back above 0.29. I don't know when this will happen, but it's one of the ones that I'm tracking every day, looking for a confirmation signal. And the reason, once again, those red dots that you just saw on the last screen, the dates of those red dots are on the left-hand side, and how the NASDAQ did in the next 12 months is on the right-hand side. And you see some really powerful advances. So if we can get a confirmation from this one, I think that would mean good things for the market. And then the last one, people look at the American Association of Individual Investors, the bull-bear ratio, and it's been very bearish in the last year. And let me just go to the chart. The green line is the 20-week average of the AAII bulls divided by the bears. And so what we look for, it's the same kind of concept, not trying to pick a bottom, just looking for sentiment to get washed out and then reverse. So in other words, we've passed the bottom. It's all, I don't want to say all clear, but that's essentially what we're trying to find with this. And so you see we're down at a very low level. It's only like about 22%. So that's a 20-week average. It's got to get up to 48. So this one may take a while, but it's another one that I'm looking for. And once again, the reason why I'm looking for it is reflected in this particular table. Every time, if you look at the red dots at the top, every time there's been a red dot, the next 12 months, the NASDAQ was higher, in most cases, by an appreciable amount. The average is about 28%. So I can't wait for this signal.
Yeah, of course.
So, and then here's basically a summary of those 5 indicators.
All right. Well, I love it that you've summed it up for us on those 5 indicators to look at. So, Jay, with all the information that you've given us here today at the Traders Summit, what's the best way for me to follow your work and what you do on a daily basis?
Well, you have to subscribe to Sentiment Trader. There's Jason, the founder of Sentiment Trader, and Dean Christians, who you've had on here a few times, and myself. We're scouring the markets every day looking for things like what I've just showed you. And it's not only just stocks. We look at the bond market, the commodities markets. There's so many opportunities out there. And that's really the way to do it. Also, on the website, we have hundreds of indicators. I mean, what I've showed you is just a very small percentage of what we have. And you can scan with those, you can sort those, what's the most bullish. And there's a lot of different types of indicators, sentiment indicators, breadth indicators, a lot like the ones that I've just showed you.
Well, Jay, I want to say, this has been a great opportunity to meet with you and hear you for the very first time here on Trader Summit. And if you guys and gals have anything that you want to add to and into the comments, make sure you jump down below and do that. Make sure you give Jay a big thumbs up if you're watching us on YouTube. Jay, I want to thank you for spending your time with us, and I'm going to try to catch up with you maybe around the second quarter of this year and see where we stand and see what you're seeing.
Very good. Thank you for having me on, Blake. I really appreciate it.
All right, Jay, thank you very much and have a great weekend.
You too.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.